All right, hello everyone. We took a little liberty with the exact prompt because there's actually a lot of independence in how you define this. You could talk about this being derivative-based token equities versus not derivative-based token equities, like X stocks versus, say, superstate. But we instead chose to take the route of making this more a debate about the perpification of TradFi assets versus spot or collateralized TradFi assets, mainly because that's a more pertinent topic nowadays and people are more interested in it. So we're going to be arguing that you should be using the spot assets, and they're going to be arguing that you should be using the derivatives assets. So with that, I think we're all here at the Solana conference because we do think an increasing percentage, maybe all of the world's assets are going to come on chain in the next 10 years. The natural question to ask is, what happens to the world's largest asset class in equities? There's sort of been two main proposals for bringing equities on chain. So first, there's spot tokenization. So this is someone takes a share. Maybe it's at DTCC, maybe it's held by an SPV, whatever. We'll kind of ignore some of the details there. And they mint a token representation of that share. So it's sort of collateralized by a real share. And the other version is derivative tokenization. So this is sort of what you're seeing as being very popular in perpetuals dexes right now. And that is where you have a synthetic representation of the equity asset. So both methods have merit, and both are being used on chain right now. And we've seen a huge increase in demand for both of these products. But we believe that spot tokenization has better long-term properties for really bringing all these assets on chain. So let's go through a bunch of reasons just so that you can kind of see this. So first, the empirical aspect. If I look at other assets that are real-world assets that have been successful on chain, so stablecoins, tokenized treasuries, we've seen that the spot tokenized assets just do better on chain. If I look at the supply of USDC and USDT and I compare that to sort of a derivative tokenized stablecoin, USD sort of being a proxy for that, there's obviously a huge order of magnitude difference. And I think on the bond and FX side, you basically haven't seen any derivatives until recently. I think Lighter added FX perps as well as hyperliquid. So, if we think that existing real-world assets give us a roadmap, then we kind of argue that equities will be the same. The second thing is a more nuanced thing, but it's more about market microstructure. So crypto derivatives are really successful because they're able to aggregate a lot of different types of traders, some who are short-term traders, some who are long-term traders. But one really important type of trader is the basis trader or delta neutral trader. And that trader tends to be one of the largest liquidity providers. They tend to have the stickiest capital on exchanges. And these traders need a spot asset to trade against. And I think one of the reasons you sort of find this to be popular in crypto is because the availability of spot and derivatives assets at the same venue is very common. And you can kind of see empirically that the derivatives are sort of deviating from the spot assets when you look at the hyperliquid perps right now. The third thing is mechanistic versus operational complexity. Now, bringing any type of off-chain asset on-chain involves some form of complexity, whether it's operational, i.e., I'm Tether and I have to custody a bunch of dollars at banks somewhere, or mechanistic. I'm a derivatives exchange. I have to choose how I compute funding rates. I have to choose how I compute oracles. And we've already seen with a lot of the HIP-3 hyperliquid exchanges, the oracles have not been necessarily chosen really well. I think Ventuals has changed their oracle multiple times. Trade.xyz has a lot of parameters for their oracles. And finally, I'm going to kind of bring two of the TradFi pieces that spot tokenization is very useful for. The first is governance rights. If I go buy XYZ 100 on Hyperliquid right now, I can't vote with it. I buy Google on Hyperliquid, I can't vote with it. But the underlying tokenized representations do allow you to have governance rights. And finally, dividends, stock splits, and other events. Dividends are really only given to the real share. And in theory, you could imagine that derivatives pricing and the funding rate would include the derivative. But this is a little bit like the AMM versus CLOB debate. It's just more inefficient to have to price it by arbitrage. So I think these complexities put together, especially when added together, they compound to make spot equity tokenization superior. Derivatives will always exist, but they need to be tethered to the spot asset. And with that, I rest. Oh, should I have gone there?
Oh, shit. That's what Arush was saying.
Hi, everyone. I'm not looking for limelight. I just don't want to be in the center. I was nudged to be in the center. My name is Shrey, and I'm here to reject the false choice that my colleagues here are forcing on us, that this is a binary choice between tokenized cash equities or tokenized derivative equities. Our goal is to build internet capital markets. Our goal is not to build an internet cash equities brokerage. And that just goes back to the 3 points that my colleague here mentioned, the empirical evidence that spot tokenized assets operate better in the tokenized world. We're pointing to bonds. Bonds themselves are empirically way more illiquid in the TradFi world than they are compared to than cash equities.
Point of information? Oh, shit, sorry. Point of information. US Treasury bond market, most liquid market in the world. How do you respond to it? Fixed income not being liquid.
Outside of sovereign debt, as soon as we get into credit and corporate bonds, we are talking about inventories that are way, way smaller than US Treasuries. I fully agree with you that US Treasuries are by far the most effective markets, which is why on-chain tokenized versions of treasuries are looking to build repo markets, not just buy and hold tokenized treasuries. So we are actively building derivative markets on tokenized treasuries, and that is the cash part of it just makes up the base component that you need. And that actually leads me to the other point that my colleague made. You need the underlying spot asset as a reference for the tokenized derivative. I fully agree to that. But what you don't need is that underlying reference price should also be on-chain. The advantage with tokenized derivatives of equities is that they can benefit from the liquidity of traditional cash equities as well as tokenized cash equities and tokenized equities. How do we do that? If we have a perp market referencing equities, we can use the more liquid pricing from the traditional world during the weekdays and still rely on on-chain price discovery during the weekends to make sure that perp markets operate efficiently. We can get regulated price feeds from tapes to reflect that data on-chain and not run into the Oracle issues that my colleague mentioned as well. The last thing that I would also reflect on is why are we really building these tokenized markets? And the objective, or the key objective, is access. Tokenized cash equities are great for people who want to buy and hold on-chain. You can buy them, you can get economic exposure. But let's look a bit further outside of where we are operating. The US markets, cash equities, the ratio of derivative notional on cash equities traded in the US every day is 4 times on the derivatives versus the cash equities volumes. As soon as we spread out into markets like India and Korea, the notional traded on derivative equities is 15 to 20 times higher than the cash equities themselves. So if you want to allow access to retail from these markets, we need to be able to have all kinds of instruments. Cash for buy and hold, and derivatives for risk-managed, capital-efficient access to these products. And the last thing really is, we go with the cash equities platform-led tokenization of stocks. We're adding another layer of platform risk, which we are all willing to underwrite and work towards making it as close to the traditional world as possible. Our colleagues here are doing some incredible work, making sure we work directly with the CSDs like DTCC, OCC, so that the tokenized stocks are no way inferior than the traditional world. But derivatives completely circumvent that platform risk that exists today. So we need to be able to have the tools in our arsenal to onboard the next billion users who want to transact on-chain. And I feel like I'm being nudged off and asked to wind up with the music. But the last thing is, I think we just have to look to prediction markets for an example of an on-chain market that works really well while driving its inputs and outcomes from the off-chain traditional world. The best solution here really isn't it's a cash versus derivatives battle. The best solution here is let's bring all of the tools to market. Let's bring it for the people who want it to buy and hold. Let's bring it for the institutions who want to run volatility strategies, capital efficient access. And that's how we make tokenized markets way better than the traditional markets themselves. Thank you.
Thank you so much for your useless arguments. Just before I say anything, Alpaca is a regulated entity. Nothing I say here is reflective of my employer, because this is a simulated debate argument. But I will begin with the comment that my colleague just made about derivatives circumventing the platform risk represented by the, I suppose you were referring to the centralized nature of DTCC. There are a couple of new risks that derivatives introduce into the system. One is how do you price these derivatives? If these derivatives are aiming to track the underlying, how do we need to trust that the derivatives contract market operators are sufficiently capable to deal with stock splits, mergers, three-way mergers, reverse splits, all the, calculating the correct split ratios. This is something that even the NYSE recently screwed up, resulted in billions of dollars of lawsuits. And then when the prices don't really exist on the weekend, we've seen Redstone, for example, come up with an EMA-based next tick prediction of the price. If the next tick can be predicted algorithmically, doesn't that introduce a risk that market makers get picked off? I mean, if you can predict the price, is it really a market?
Thank you for rebutting the platform risk. I subscribe to the view that I would rather take DTCC risk, but what if the platform risk is not DTCC or OCC doing their job correctly, but the issuers of tokenized cash equities who are adding another layer of platforms, not the underlying CSDs, but the issuers themselves?
Yes, so this actually gets to the heart. It gets to the heart of the wrapper model versus the direct DTCC tokenization model. And I've actually been working Alpaca. We've been working directly with the DTCC and Canton network to see actually how are they tokenizing these stocks. And when you get into the mechanics of integrating with them, it turns out that the DTCC is simply just locking the actual underlying share and issuing a token collateralized by it. So it itself, it is also a wrapper. It is also a derivative type wrapper. So I'm not sure that there is much of a difference. I'm not sure that answers your question either. Sorry. Yeah, so another point that you mentioned was the volume is vastly larger through derivatives than the spot underlying asset. However, if you look into the data, it does seem that that volume is driven largely by indexes only and not the long tail. So we do reject that point. Yeah, I think that's all I have today.
All right.
All right, hello everyone. So I'm the second speech on the opposition, and so this should be the final kind of substantive speech of this debate. So I want to clarify a few things. First of all, the resolution states that we're rejecting any derivative-based model. So the only burden that the negation has is actually just proving one case where we shouldn't reject this model. And then beyond that, it, again, like my partner suggested, we're not suggesting that they're necessarily mutually exclusive. And so given that, I'd like to also clarify what it means or what would be grounds for rejection. And so kind of some of the things to clarify and like what I would define as better for crypto is something that's better for the short-term growth of crypto and activity, better for the users from a UX perspective, and then also better for the long-term like vision of crypto. And so one example in which derivative-based models are actually beneficial to crypto is for the tokenization of public equities. So there isn't really, if you think about who the users in crypto are today, they are folks that are looking to leverage and speculate on price. They are traders. They are not investors. No one who is buying NVIDIA on chain is looking to vote in shareholder meetings. And to rebut one of the pro team's points. And so that is the case where a perpification, in this case, or like a perp model for tokenizing these equities makes more sense because you have lower fees, you have greater exposure, and less capital requirements to bootstrap all sorts of new markets. It doesn't make sense for, as an industry, us to be competing with TradFi on execution when almost all of NVIDIA right now trades on like off-chain with all the liquidity there. We should be focused on places where we can actually compete. And so in that context, it's better for users and what users actually want to do on-chain. And so I want to address a couple of the arguments on the pro side. One, which was looking at anecdotal evidence today where spot tokenized assets do better. And the reference point was stable coins. But in stable coins, you're not actually looking for exposure to the underlying. No one actually gets treasury yield. You use USDC for payments, not for trading. And so what's that?
I would say that almost all the new stablecoins are passing through yield in the form of rewards. So like, actually, my real question is, you mentioned that there's lower fees in derivatives. I don't think that's true, like in general. Like, why should one believe?
I think that's irrelevant to the point. The UX of trading derivatives and for when there's not a lot of liquidity on chain, it's superior. A spot market where you're trading a perpified version of the asset over a tokenized spot version works better without liquidity on chain in the perp model or the derivative-based model. Like, I think fees are ancillary to the point.
Okay.
And then the other idea was he was talking about spot tokens being good for governance and stock splits, and so that was one of the four arguments. And the point that Arush came and made around the kind of SPVs that are holding stocks, you actually don't get when you hold different tokenized stocks on Solana to get today governance rights and voting rights for most of the different variants. So I'm not sure that the tokenization use case actually works there. And then the other kind of argument that Arush had made was that derivatives circumvent, or was that derivatives hold the same platform risk. You're taking on a lot of counterparty risk in the kind of tokenized, you're a lot of the times investing into an SPV that holds these underlying assets. And so you are, instead of your risk being a smart contract and a verifiable decentralized set of smart contracts, you are instead taking counterparty risk and operational risk and legal risk that is less visible to the kind of the transacting users on that platform. And so kind of to close out the last argument is for the derivative-based models for tokenized assets, the kind of only thing you need to buy into is that it makes more sense for the user and for crypto to actually be able to compete on these different markets for us to start with a segment of the market that actually we have some sort of advantage, or the user experience is actually at least at par. If we have all these different markets where there's $100,000 worth of liquidity and you're trying to make $1 million trade, your execution is going to be way worse on chain. And so we need to start where we can actually make headway and have folks. And if you look at kind of some of those HIP markets right now, the HIP3 markets, you're seeing a lot more volume on those markets compared to tokenized equity markets that exist on chain today, where you're looking at the spot tokenization. And now I believe it's closing speeches.
Yep. I think you guys go first.
We go first for closing?
Yeah.
Do you want to close this out?
So So I could spend the next 2 minutes trying to fundamentally dissect the fundamentally flawed points that my colleagues made here, but I'm just going to summarize why this is a pointless argument. My colleague said basis traders need cash equities to be able to have that part of the leg, but what he failed to mention and intentionally hid is that basis traders also need the derivative leg to actually run a basis trade. The second point is access. If you're really talking about access, let's talk about access more generally, more broadly. With just cash equities, we're not going to get any institutional adoption. We're going to shut out a very large part of the emerging markets, retail crowd as well. And we're building for a very small part of the market. The last thing on fees. Looking at fees in isolation is, again, a false choice. We really need to look at capital efficiency rather than just platform fees. With just cash-based models of equity access, you need to put up the whole amount of capital. Every dollar of capital gets you $1 of exposure. The only way to get capital-efficient exposure to equities is via derivative markets. And that's why both of these markets need to operate in tandem rather than in isolation with each other. Our goal is not really here to pull down the issuers and platforms that are doing the great job of bringing tokenized cash equities on chain. Our goal here was to prove the point that alongside that, you need well-functioning, liquid derivative markets that bring the best of tokenized cash equities and traditional equities to the on-chain audience. I rest my piece.
All right. I think our colleagues here have really redefined the notion of accessibility. It sort of reminds me of a US president redefining the notion of affordability recently. Crypto should be expanding access to US equities and worldwide equities. Derivative models expand access only to basically zero-day options, right? Everything is truly about pure gambling, more than real stocks. You're not going to get your dividend saver. You're not going to get your person who wants composite indices. And you're also just not going to get the overall ownership value of an equity asset. Now, I agree that many people in the world don't want to vote. But there are also many people who like to be paid for their vote. And in crypto, the actual equity, tokenized equity asset allows for that market to be created on its own. The second thing that our colleague here described is that to do a basis trade, you need derivatives. That's certainly true. But if the derivatives market is to have sufficient liquidity from basis traders, they need to be able to trade 24/7. They need to be able to have some price guarantees on the opening auction on Monday morning. And without the spot tokenized assets, you're effectively forcing people into the 9-to-5 regime or whatever the hours are in that jurisdiction. And that is not a true 24/7 internet capital market. That is a very restricted, time-bounded market. Finally, I think my colleagues pointed out that there's a lot of counterparty risk in tokenized equities. I would argue that a much worse counterparty risk is the oracle risk. The oracles for tokenized stock equities have a lot of parameters. They change a lot. They're not super interpretable. And in a lot of ways, that actually makes the risk of getting blown out, as we saw last week on Venturals, much more likely in derivative assets. And I'm not sure if we want the average retail user doing that. So, yeah, with that, I'll close. I think...
Thank you, guys,
thanks,
for the
everyone.
debate. I think we're done.
Thank you.
Great.
Thank you. So, did you guys think, were you expecting the winning team to be green? Oh, it's changing. Vote's still going. Is anybody going to vote purple? Green?
Are we allowed to vote?
I voted.
You voted.
Yeah.
Now everyone gets to vote.
Now everyone's voting against.
Oh, man.
All right.
Are we?
So, yeah, I think you guys are good to leave. Thank you, everybody.
Thank you.
Please give an applause to our speakers.